Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about the risk-free rate of return. That risk-free rate of return is oftentimes defined as the amount that a routine investor can expect in a zero-risk environment. Now, because there is no such thing as zero risk, that is currently or most commonly referred to as the 3-month Treasury yield. So you can see right here that I have selected US Treasuries as my example under key rates and benchmarks here on the right-hand side of your screen. And under the 3-month option, you can see that yield is 4.69%. Now, it's important to note that when we're referring or evaluating these percentages right here, these are annualized percentages. So this does not mean that if you purchase this 3 months later, you will pull out $469 if you put in $10,000. Rather, you would have the annualized yield of that, which would essentially be 1/4 of that. And the reason why this is considered a risk-free return is because in theory, the United States cannot default on this debt. However, again, this is just a theory. The United States does have the capability to default just like any other sovereign nation. One of the reasons why this is such a pertinent conversation, though, is because we are anticipating another 25 basis point rise in interest rates. For every time interest rates rise, generally speaking, you are going to see a corresponding rise in the US Treasury rate, while not necessarily a 1-to-1 ratio. So the important thing to note is as we're evaluating some of these calculations here, and you can see US Treasuries up here on kind of the 1-year basis down, and you can see this down below as well. But in the 6-month to 1-year basis, we're around 5.1%, a little bit under that. So the question is, with each increasing investment or with each increasing basis point hike, you have to wonder how many investors, especially those with larger sums of cash, are going to be more willing to take out money from more risky investments and place it in these returns where you can get 5%. The reason why I highlight this is because if we talk about historical returns on investment, and we look at SPY right here, you can see that within this calculation, we have the capability to evaluate different performance over historical time periods. So on a year-by-year basis, in the past 5 years, you can see pretty large-scale annualized returns. However, on the right-hand side of the screen, you can see tax-adjusted returns on a 3-year average, as well as pre-tax return on an average. So this 9.84% is over the past 3 years, which in those conversations, I would call out that 2021 was an insane year for investment returns, especially if you were in some of the stocks that saw triple-digit returns. And then again, we gave a lot of that back on a market basis in 2022. Now, 2023 has started off quite strong. However, I'll recall that once again, when we're evaluating these performances, and I'm showcasing the historical performances right now, that even on a since inception basis for SPY or the SPY fund, which is an S&P 500 market indices, is that on average it's been 9.71%. So while this is very high risk, or rather since the market is high risk, the question is, am I willing to risk this investment right here or take risk-free amounts of money at 5%, especially if that number starts to get closer to 6% to 7%. And while you may be looking at it and evaluating on a $1,000 portfolio, on a $10,000 portfolio, these are very different numbers if you are looking at hundreds of millions and or billions of dollars, where they're going to start saying at a certain basis point, there's always going to be tipping points for different investors. At which point am I willing to sacrifice some of that risk to lock in those long-term gains? So while these trends look very promising, the question is at what point are we going to start seeing money pour away from these larger funds, from this money here, and start going into some of those bond portfolios where we have that guaranteed rate of return. So this is what I am expecting to see coming up over the next few months as we continue to see additional interest rate increases. We're currently expecting another 25 basis points in the next hike, followed by another 25 basis points, which again, while not exactly 1-to-1 to that risk-free rate of return on a 3-month basis, the expectation is that even if those were to go up another 50 basis points, we are now going to be north of 5.5% on the 3-month Treasury. And I think that is very tempting. And again, that is strictly on those Treasury rates. That is not included in things such as CDs, which also are going to have very attractive rates in here as well. So you can see even those CD rates right there, you're talking north of 5% on those 1-year terms. So there's a lot to look at. It's important to note that you have other investment options. You are not strictly limited to stocks, ETFs, index funds, or options. They're also very safe returns or means of investments, especially if you are someone who should be evaluating more capital conservation strategies, especially as you are closer to retirement. So let me know in the comments down below if you've ever purchased CDs or bonds, or what your investment style is in this turbulent market. Let me know. Thanks for watching. Talk to you later.